Imagine you're about to place this huge order on the stock market, right? Hundreds of thousands of shares, maybe.
Yeah, something really significant.
Big enough that, everyone expects it's going to nudge the price. Now imagine someone else with advanced knowledge of your intention.
Before you even act.
Exactly. They race ahead and trade for their own account just seconds before you do. And they profit from the price move that your big order is about to cause.
Or, okay, picture this scenario. A trader just floods the market with massive buy orders for some stock.
Yeah.
Creating this, total illusion of overwhelming demand, right? It pushes the price up.
But they don't actually want to buy.
Zero intention. None. Their real play is, say, a small sell order they placed a bit earlier.
Ah, okay.
Which suddenly becomes profitable because the price is rising from all that fake demand they created. Then, just before those huge buy orders could possibly get filled, poof.
They cancel them.
Gone. Canceled in milliseconds.
Wow. Okay, so these aren't just, theoretical ideas from some financial thriller movie.
Not at all. These are real. They're illegal tactics used to manipulate markets.
And they really strike at the heart of fair trading, don't they?
Absolutely. Undermines the whole system.
And that's precisely what we're diving into today. We're going to unpack two specific, but importantly, quite distinct illegal tactics used in financial markets: front-running and spoofing.
Right. And to help us navigate this complex landscape, we've pulled together a pretty solid stack of sources.
Okay, what do we got?
Well, we've looked at the formal definitions, the actual rules from the regulators who police this stuff. Bodies like FINRA.
The Financial Industry Regulatory Authority.
Yep, them.
Yep.
And the SEC, the Securities and Exchange Commission, and also the CFTC, the Commodity Futures Trading Commission.
Big players in regulation.
Exactly. They set the groundwork.
We've also dug into financial news reports, right? To see how these schemes actually play out in the real world.
Yeah, and the consequences for the people who get caught. Plus, we've reviewed legal analysis, which is really interesting, breaking down key court decisions that have shaped how these laws are enforced over time.
And we even checked sort of general financial knowledge bases, like well-known online encyclopedias.
Right, just to make sure we're covering the foundational concepts clearly. Get the basics down.
So these sources give us the regulatory backbone, the real-world impact, the legal history, and kind of the broader context of how these practices are understood.
Precisely. A multifaceted view.
So our mission today is pretty clear. We want to take you, our listener, on a journey through all these sources.
Yeah, let's unpack it all.
We want to understand what front-running and spoofing actually are. How do they work? Why are they so definitely illegal?
And crucially, how regulators and the firms themselves are battling to, detect this stuff and prevent it from happening.
We'll try to extract the most important nuggets of knowledge and insight. The goal is to equip you with a really clear picture of these tactics.
And their deep impact, really, on the integrity of our financial markets.
Okay, where should we start? Front-running.
Let's begin with front-running. Sounds good.
Okay, let's unpack this concept then. When the sources talk about front-running, what's the fundamental definition we're working with?
Okay, so at its most basic level, front-running is this illegal practice where someone who has advanced non-public information.
Key phrase. Non-public.
Absolutely critical. Non-public info about an expected large transaction in some financial asset, could be a stock, a bond, a future, whatever.
Right.
And they use that information to trade that same asset or something very closely related for their own account before that big transaction actually gets executed.
So they know it's coming.
They know it's coming, and they anticipate it's probably going to move the market price. They're jumping the queue, essentially.
So it really is about getting an illegal head start based on that privileged information.
That's it, exactly. It's that knowledge of an imminent market-moving event, specifically, usually a large transaction or block of transactions that other people just don't have access to.
And they exploit it for personal gain.
Right. Which is why, it often gets compared to insider trading.
Yeah, I can see that.
Although the source of the info is typically different, here it's more about market activity, like a big order, rather than, say, confidential corporate news like merger.
Got it.
And the sources also mention it's sometimes called tailgating or maybe trading ahead. Although, the formal regulatory definitions, especially from FINRA, they really focus on that specific context of knowing about an imminent block transaction.
Okay. Given that definition, The reasons why this is illegal and, frankly, unethical seem pretty straightforward, don't they?
They really are, and the sources we looked at emphasize several core reasons. Primarily, it's a form of market manipulation, plain and simple.
How so?
Well, by trading ahead of a large market-moving order that you know is coming, you're basically interfering with the natural price discovery process.
Right. The market finding the price on its own.
Exactly. You're profiting unfairly from a price change that hasn't happened yet, based on, genuine supply and demand reacting to public information.
It just feels inherently unfair when you put it like that.
It is. And, for financial professionals like brokers or traders who handle client orders, it's a massive breach of their fiduciary duty.
Their obligation to act in the client's best interest.
Precisely. They have to put their clients first. Front-running is the exact opposite. It's prioritizing their own personal profit, or maybe the firm's profit, over getting the best possible execution price for their client's large order.
Which, I guess, leads to the biggest point. It fundamentally violates market fairness.
That's the crux of it. It puts traders with this secret, advanced knowledge at a huge, unfair advantage over, well, pretty much everyone else in the market who's trading based on what's publicly available.
And if people lose trust that the markets are fair,
they pull back. Confidence erodes. Markets become less efficient, less liquid. It damages the whole ecosystem, which is why, regulators take it extremely seriously and have very specific rules against it.
Okay, let's delve into that regulatory framework then. The sources point to some very specific rules, especially from FINRA, the Financial Industry Regulatory Authority.
Yes. FINRA has a really key rule here, Rule 5270. It's quite detailed and directly targets front-running.
What does it say?
Essentially, it prohibits a FINRA member firm or anyone associated with that firm from executing an order to buy or sell a security or even a related financial instrument.
Okay, not just the stock itself.
Right, we'll come back to that. But they can't trade these things when they possess material, non-public market information about an imminent block transaction in that security or instrument.
Imminent block transaction, okay.
And that restriction stays in place until the information about that block trade is either publicly disseminated or it's basically become old news, stale.
So it's not just having a hunch. They need to have pretty concrete, non-public knowledge that a specific large trade is about to happen.
Exactly right. And that phrase, material, non-public market information, in this context, according to the FINRA source materials we reviewed, means knowing that a block transaction has been or will be agreed upon imminently.
Even if they don't know all the details.
Right. You don't necessarily need to know every single term of the trade, just that a significant, potentially market-moving block is about to hit the tape.
And you mentioned related financial instrument. What does that cover? You said it's not just the stock.
Yeah, the sources are clear. It's broader than just the underlying security. It includes things like options on the stock, futures, derivatives, security-based swaps.
So ways to trade based on the stock's price movement.
Exactly. Essentially, any financial instrument that gets its value from that underlying security and basically acts as a functional economic substitute for owning the stock itself. The rule is designed to stop front-running across the whole spectrum of linked instruments.
That makes sense. Who exactly does this rule apply to? Is it just the one person who hears about the order?
No, it applies quite broadly within a member firm. It covers orders executed for accounts where the member firm itself or the associated person has a financial interest, or accounts over which they exercise investment discretion. And interestingly, it even covers accounts of customers or affiliates if that confidential information about the block trade was provided to them by the member or associated person.
So they can't just tip someone off either.
Right. It's designed to prevent exploiting this knowledge through various channels, direct or indirect.
And when is this information considered publicly available, so the trading restriction lives?
The FINRA sources clarify that publicly available means the info has gone out through official channels. Think like a last sale reporting system, the tape, or announcements on exchanges, alternative trading systems, ATS, or major third-party news wires like Reuters or Bloomberg.
Okay, official dissemination.
Crucially, though, for a block transaction, the entire transaction needs to be completed and publicly reported for the information about that specific block to be considered fully public.
So just starting the trade isn't enough?
No, just starting doesn't cut it. The whole thing has to be done and dusted and reported.
And what actually counts as a block transaction itself under this rule? Is there a specific number?
Well, there's a general guideline, particularly for stocks, that 10,000 shares or more often counts as a block.
Right.
But the sources really emphasize it's not a rigid, hard and fast minimum number. A trade of fewer than 10,000 shares can still be considered a block if it's large enough to have a material market impact.
Ah, so it depends on the stock's liquidity, too.
Exactly. It acknowledges that for some less liquid stocks, even a smaller number of shares can significantly move the price. And also, if a really large block order is broken up into smaller pieces for execution, the rule still applies to the knowledge of the overall intended block transaction. You can't just chop it up to avoid the rule.
That distinction based on market impact makes a lot of sense.
Yeah.
So FinNR is very specific here, but you mentioned other major regulators like the SEC and CFTC also prohibit this, right?
Oh, absolutely. It's not just FINRA. The SEC has Rule 17J1, which is part of the Investment Company Act's Code of Ethics.
Okay.
And that rule includes provisions that prevent certain insiders, like portfolio managers or brokers working with registered investment companies, from using their knowledge of upcoming client trades for their own personal benefit. So that covers many forms of front-running involving mutual funds and similar entities.
And the CFTC. They regulate commodities and futures.
Right. The CFTC explicitly classifies front-running as a prohibited abusive trading activity under Section 37.203A of its regulations. So it's covered in the futures and swaps markets, too.
And is this just a U.S. concern, or is it seen as bad practice globally?
No, not at all, just the U.S. The sources point out that regulators internationally, like the Financial Conduct Authority, FCA, over in the UK, and the European Securities and Markets Authority, ESMA, across Europe, they consider this type of activity a serious form of market abuse. Regulations like the Market Abuse Regulation, or MA, in the EU, that's Regulation EU, No. 596/2014, they have similar prohibitions against exploiting confidential information related to market transactions.
So it's pretty universally condemned.
Yeah, it's globally recognized as a threat to market integrity. There's a broad consensus on that.
Okay, let's try to bring this to life a bit more for some common examples. The sources must describe typical ways this plays out, right?
Definitely. The most classic scenario, kind of like we touched on in the intro, involves a broker-dealer getting a large order from a client.
Okay.
So imagine a broker at a big firm gets an order from a major institutional client, like a pension fund, to buy, say, 500,000 shares of company XYZ.
That's a big order.
Huge. And the broker knows, just from experience and the size, that this volume is highly likely to drive the stock's price up as it gets executed in the market.
So the broker now has that confidential, non-public information about this imminent large purchase. That's the trigger.
That's the trigger, exactly. Now, before placing the client's 500,000 share order onto the market, the broker, maybe acting for the firm's own trading account, their proprietary desk, or maybe even a personal account they control, they quickly buy a smaller number of shares, let's say 5,000 or 10,000 shares, of that very same stock, company XYZ. Maybe they buy it at the current market price, say $50 a share.
Okay, they jump in first, and then they execute the massive client order.
Right. And just as they expected, the execution of that 500,000 share order creates significant buying pressure. It pushes the stock price up. Let's say it climbs from $50 to $52 pretty quickly.
Okay.
Now, the broker who sneakily bought those 10,000 shares at $50 for their own account immediately turns around and sells them at the new higher price of $52.
Pocketing the difference.
Exactly. Pocketing a $2 profit per share. On 10,000 shares, that's a quick $20,000 profit, basically risk-free, generated entirely off the back of their client's impending order.
Wow. They essentially used their client's order as a tool to make money for themselves.
Precisely. And the sources really highlight that this isn't just unfair from a profit perspective, it can actually harm the client too.
How so?
Well, think about it. The broker's own front-running purchase, even if it's smaller, might itself nudge the price up slightly before the client's massive order even starts getting filled.
So the client ends up paying more.
Potentially, yeah. The client might end up paying a slightly higher average price for their 500,000 shares than they would have if the broker had just executed their order immediately and efficiently without trading ahead for themselves first. That's the core of the breach of duty, that potential client harm.
Okay, that's the classic broker example. What about the one involving anticipating news or recommendations?
Right, that's another common scenario described. This involves people inside a financial firm who get advance, non-public knowledge about some upcoming market-moving event or, say, a research report.
Like an analyst's rating change.
Exactly. For instance, maybe an analyst at a prominent investment bank is just finishing up a highly anticipated research report, and in it, they're going to recommend a strong buy on a specific tech stock.
And they know, or people at the firm know, this report is going to generate significant buying interest and likely push the price up once it's released to the firm's clients and maybe the public.
Precisely. So with this advanced knowledge, the analysts themselves, or perhaps someone else within the firm who has access to this information before it's public, maybe someone on the trading desk who sees it internally, they buy the tech stock for their personal trading account before that report is officially distributed or published.
Boom, the report comes out, the price jumps.
And that individual sells their shares at the higher price, netting an unfair profit based purely on information that nobody else had access to yet. The sources make it clear this is also a definite form of front-running, exploiting confidential info about forthcoming market-moving analysis.
And the sources also mention scenarios like a trader using their personal account specifically to trade ahead of a client order they know about.
Yes, that falls right under the same umbrella. It doesn't really matter if it's the firm's account or a personal account.
Yeah.
Any instance where a professional knows about a client's upcoming trade and prioritizes their own trading, violating that duty to the client, that's prohibited front-running. The client's interest has to come first.
Okay. And they also briefly touched on a client and client situation. What's that about? Sounds a bit different.
Yeah, this refers to a less clear-cut scenario. It's where one client's perfectly legitimate trade might, just by coincidence and market timing, appear to benefit from knowledge of another client's trade happening around the same time.
So not necessarily intentional wrongdoing.
Not necessarily, no. The sources mention the situation can occur, and while it might not be malpractice, it usually triggers compliance reviews within the firm. They'd investigate to make absolutely sure there wasn't any improper sharing or misuse of confidential information between the clients, perhaps facilitated inadvertently or intentionally by someone at the firm. It needs checking out.
Okay, so the general principle is crystal clear. Don't trade on non-public knowledge of incoming market activity, whether it's orders or news. But are there any situations that might look similar but are actually permitted under the rules? The sources mention some exceptions to that FinNoir Rule 5270.
Yes, that's important. The rule isn't meant to just completely stifle all trading activity, only the abusive practice of exploiting that confidential market information. So Rule 5270 does carve out some specific exceptions.
Like what?
Well, one major exception is for transactions where the member firm can clearly demonstrate they were genuinely unrelated to the material, non-public market information about the block order they might have possessed elsewhere in the firm.
How do they prove that?
A common way is through having robust information barriers, often called Chinese walls, within the firm. These are procedures and systems designed to strictly separate departments that handle confidential client order information, like an institutional sales desk, from other departments that trade for the firm's own account or for other clients, like a proprietary trading desk or market-making desk.
So if the trading desk literally didn't know about the incoming block order because of these internal walls, their trading wouldn't be considered front-running related to that specific order.
Exactly. If the information barrier is effective and properly maintained and documented, then trading done without that knowledge is generally permissible.
Okay, what other exceptions are there?
Other exceptions listed include transactions that are related to a prior customer order in the same security, or trades made purely to correct a genuine error, like if a trader accidentally bought when they meant to sell.
Makes sense.
Or transactions involving odd lot orders. Those are typically trades of less than 100 shares, usually considered too small to impact the market significantly on their own.
Right. Now, there's a specific carve-out mentioned for transactions related to actually facilitating the customer's block order itself, right? That sounds a bit counterintuitive at first glance. How can you trade related to the order without front-running it?
It does sound tricky, but it's a really necessary practical exception. Think about it. If a client wants to buy or sell a massive block of stock, the firm handling that order might need to execute some related transactions themselves to manage the risk or source the needed liquidity to fill the client's order efficiently without causing a huge disruptive price impact.
Like hedging their own risk from taking on the other side of the client's trade temporarily.
Exactly. Or maybe buying shares incrementally to accumulate the block before selling it to the client, or vice versa. The rules allow this kind of facilitating activity, but, and this is a huge but, only under very strict conditions.
Okay, what are the conditions?
The firm must ensure these facilitating trades minimize any potential disadvantage or harm to the execution of the customer's block order. And they absolutely positively cannot prioritize their own firm's financial gain or inventory positioning over fulfilling the customer's trade efficiently and at the best price reasonably available under the circumstances. The client's interest remains paramount.
And the most critical condition here, the sources really stress this, is getting the customer's consent, right?
Precisely. That's the linchpin. Any such facilitating trading activity by the firm that could potentially impact the market price ahead of or alongside the customer's large order requires explicit customer consent.
How does a firm get that consent?
The sources outline a few ways this can be properly obtained. It could be through affirmative written consent from the customer where they sign off on the firm's handling policy, or it could be via something called a negative consent letter, where the firm clearly discloses its policies for handling large orders, including potential facilitation trades, and the customer is given a chance to object but doesn't.
So silence implies consent in that case, after full disclosure.
Yes, provided the disclosure is clear and the customer has a reasonable opportunity to object. Or consent can even be obtained through documented order-by-order oral consent, where the broker explains how they might need to trade to facilitate this specific large order, and the customer understands and agrees verbally, with the firm keeping a record of that conversation.
So transparency and agreement are key.
Absolutely. The key is transparency and the customer explicitly or implicitly agreeing to how their large order might be handled in relation to the firm's necessary facilitating trading.
Okay, that really clarifies the permitted activities and their strict conditions.
Wow.
Now, are there any other concepts floating around that sound similar to front running, but are actually quite different or maybe fall into more of a gray area?
Yes, the sources do make some important distinctions. We've already mentioned insider trading, similar in that it involves exploiting non-public information, but distinct because the information typically comes from inside the company, like knowing about an unannounced merger, earnings surprise, or drug trial result, rather than originating from knowledge of imminent market trading activity like a large order. Source of info is different.
Got it. And you noted earlier that trading ahead, while sounding similar, isn't necessarily the exact same specific prohibited practice as defined under FINRA Rule 5270.
According to some of the source materials, yes. While trading ahead broadly refers to brokers trading for their own account before a client, the specific regulatory violation called front-running under FINRA 5270 is very precisely tied to having that material non-public knowledge about an imminent block transaction. The definitions can be nuanced.
Okay. What about payment for order flow, PFOF? That's a practice that gets a lot of headlines and criticism. Is that front running?
PFOF, as the sources explain it, is when brokers, particularly retail brokers, receive compensation, usually a tiny fraction of a cent per share, for routing their customers' orders to a specific market maker or wholesale firm for execution.
Right. Firms like Citadel, Securities, or Virtue often pay for this flow.
Exactly. It's controversial because critics argue it creates a potential conflict of interest, that the broker might be incentivized to route orders based on the payment they receive, rather than solely on getting the absolute best execution price for the customer.
So is it front running?
The sources are clear. No, it is not considered front-running.
Why not?
Because the market maker who receives the order flow is trading with or against the customer's order after they receive it. They aren't trading in front of it based on confidential knowledge of the order before it was even sent to them or entered into the market system. The issue with PFOF revolves around best execution obligations and transparency about potential conflicts, not the specific mechanism of trading ahead based on non-public order information.
That's a really crucial distinction to understand. Okay, what about index front running? I saw that specifically noted in the sources as not being illegal. How does that work?
That's right. Index front running is a well-known trading strategy, and it's generally considered legitimate. It involves traders anticipating the predictable portfolio adjustments that large index funds have to make.
Like when a stock gets added to the S&P 500.
Exactly. When a stock is scheduled to be added to or removed from a major index, like the S&P 500 or the Russell 2000, all the massive index funds and ETFs that track that index must buy or sell that stock, respectively, to match the new index composition. This creates very predictable, large buying or selling pressure, usually concentrated around the market close on the specific day the index rebalances.
And traders know this is coming.
Yes, because the index providers like S&P Dow Jones Indices or FTSE Russell announce these changes publicly well in advance of the effective date. So traders who know about the upcoming index change will often try to buy the stock before it's officially added, anticipating the forced buying from index funds will push the price up, or sell or short the stock before it's removed, anticipating forced selling. They profit from the predictable price movement caused by the index funds trading.
So the absolute key here is that the information about the index change itself is public information, not confidential.
Precisely, because the core information, which stocks are changing and when, is publicly announced ahead of time. Trading based on anticipating the consequences of that public information is considered a legitimate arbitrage-like strategy. It's not illegal front-running, which relies on non-public, confidential knowledge of specific orders or events.
Got it. Public info equals fair game. Non-public info equals potential front-running.
Okay, and what about that short seller analyst recommendation example you mentioned earlier, where a short seller takes a position and then publicizes their negative research? That sounds like it could be manipulative.
The sources discuss this as definitely being a gray area, but one that is generally not considered illegal manipulation, provided certain important conditions are met.
Okay, what are those conditions?
If a short seller conducts genuine, fact-based research that leads them to believe a company's stock is significantly overvalued or that the company has serious undisclosed problems, and they take a short position based on that research.
They are generally permitted to then publicly disseminate that research and their negative view, even if they know or hope it will cause the stock price to drop and benefit their short position.
What makes that different from illegal manipulation or front-running?
A few key distinctions are usually highlighted. First, reputable short sellers are generally expected and sometimes required by regulation or best practice to disclose that they hold a short position when they publish their research. This transparency lets the market know they have a financial interest in the stock price going down.
So they're revealing their bias, essentially.
Right. Second, and crucially, their analysis must be based on genuine, fact-based research and reasonably held opinions, not fabricated information, rumors, or outright lies, designed solely to panic the market and drive the price down. It's the difference between presenting a bearish investment thesis based on facts, even if aggressively argued, and spreading false information to manipulate.
I see. So it's very different from, say, someone inside a firm knowing about their own firm's upcoming favorable research report meant for clients and secretly trading ahead of that confidential internal information release.
Exactly. The intent, the transparency about their own position, and the factual basis, or lack thereof, of the information being disseminated are the key factors that distinguish legitimate, albeit sometimes controversial, short-selling activism from illegal manipulation or front-running.
Okay, that helps clarify those tricky edge cases. Now, have we seen any significant real-world examples of front-running enforcement actions that the sources detailed, cases where regulators stepped in?
Yes, absolutely. There have been several notable cases mentioned. One significant example involved HSBC Holdings.
The global bank.
Yes. Back in 2018, HSBC agreed to pay a hefty sum, $101.5 million, to U.S. authorities to resolve charges related to a foreign exchange FX front-running scheme.
What did they do?
The allegations were that traders at the bank misused confidential client information concerning large upcoming FX transactions to trade ahead for the bank's own proprietary account, profiting from the price movements caused by their own clients' orders.
And individuals were charged too.
Yes, the former global head of FX cash trading at HSBC was also found criminally guilty in a related case, so it hit both the firm and individuals.
Wow, $100 million is a substantial penalty. That certainly sends a message.
It does. Another case detailed in the sources involved a FINNR action against Citadel Securities in 2020.
Citadel Securities, the big market maker.
That's right. FINNR penalized them for allegedly front-running its own clients' large orders, specifically between 2012 and 2014.
How do they allegedly front-run their own clients?
The allegations were pretty specific. FINNR claimed that Citadel Securities removed hundreds of thousands of large over-the-counter OTC orders submitted by its clients from its automated trading system, routing them instead for manual handling.
Okay, delaying the execution.
Exactly. And during this delay, according to the allegations, Citadel Securities then traded for its own account, buying or selling on the same side and at price levels that would have satisfied those delayed client orders. Effectively, they were accused of stepping in front of their own clients' trades while those orders were being held up in the manual queue.
So they weren't just acting on advanced knowledge, but actively, potentially hindering the client's order execution to benefit themselves.
That was the core of the allegation that this practice violated their duty of best execution and fairness to their clients by trading ahead of these manually processed orders.
What was the outcome?
Citadel Securities agreed to pay a $700,000 fine and also committed to making clients whole for any potential harm caused by this practice. It's important to note, though, that they settled the case without admitting or denying FINRA's allegations, which is common in these types of regulatory settlements.
Still, these cases clearly underscore that regulators are actively pursuing these practices, even when they involve complex scenarios, like firms allegedly trading ahead of their own clients.
Definitely. It shows it's an ongoing enforcement priority.
All right, that provides a really clear, comprehensive picture of front-running, basically. Trading based on that confidential knowledge of incoming market-moving orders or news. Now, let's switch gears entirely and talk about spoofing. This sounds like a completely different beast, right?
It absolutely is. Very different mechanism. Spoofing is defined in the sources we looked at as a disruptive and illegal algorithmic trading activity. And its defining characteristic is placing a bid or offer an order to buy or sell with the explicit intent to cancel that order before it gets executed.
Okay, so front-running is about exploiting secret information. Spoofing is about creating fake activity.
That's a great way to put it. Spoofing isn't about having confidential information about what someone else is going to do. It's about deliberately creating false signals in the market yourself, using orders that you never, ever plan to let trade.
So the key is that intent to cancel. That's what makes it illegal.
Absolutely. That fraudulent intent is the absolute core of why spoofing is manipulative and illegal. You're putting orders onto the book not because you genuinely want to buy or sell at that price, but purely because you want to trick other market participants, human traders, algorithms, whoever, into believing there's real buying or selling pressure that isn't actually there.
Okay, how does that mechanism actually work then? How does placing and canceling orders manipulate the market price?
The goal, right, is to create a false, artificial picture of supply or demand. You want to induce other traders to react and move the price in a direction that benefits a real order you have elsewhere.
Okay, walk me through an example. Let's say they want to push the price up.
Okay, good example. In that case, a spoofer, typically using an algorithm, would place a large number, maybe multiple layers, of large buy orders bids onto the order book. And crucially, they place these bids at successively higher prices, often just slightly away from where the current market is trading.
So anyone looking at the order book sees this huge wall of intended buying suddenly appear below the market.
Exactly. To other market participants watching the depth of market data, this looks like massive demand has suddenly materialized. It suggests strong upward price momentum is building, that buyers are aggressively stepping up.
It creates the illusion of significant buying pressure.
Precisely. That's the word the courts use. Illusion.
And this illusion causes other traders to react. They see the bids and start buying themselves.
Yes, that's the manipulative effect. Other traders, especially automated systems or algorithms that are programmed to react to changes in book depth and pressure, interpret this surge in supposed bids as a genuine shift in the market balance. So they start buying too, trying to get ahead of the perceived demand, and this buying pressure pushes the actual market price up toward those large fake bids.
But the scoofer doesn't actually want those large buy orders to get filled at those higher prices they posted. They're fake.
Exactly. They have zero intention of buying at those levels. That's where the intent to cancel is critical. While these large spoofing bids are doing their job, creating the illusion, fooling others into buying, and pushing the price up, the spoofer typically has placed a smaller, genuine trade order on the opposite side of the market.
So in this case, while they're faking buy orders, they have a real sell order.
Exactly. Maybe they placed a smaller sell order a bit lower down before they started spoofing, or they place it while the spoofing is happening. As the market price rises due to the false demand created by their spoofing bids, that smaller, genuine sell order becomes profitable, or it gets executed at a more favorable price than it would have otherwise.
And then, just before the rising price actually hits those big fake buy orders,
Poof. Like magic, those huge buy orders vanish. They're rapidly canceled by the algorithm, often in milliseconds, before they have any real chance of being executed.
So the spoofer used the large fake orders essentially as bait. Bait to lure other traders into moving the price, allowing their genuine smaller order on the other side to get filled profitably.
That's the essence of it. And the sources, particularly referencing key court decisions like the Cassia case, make it really clear. The fraud isn't that the spoofing orders are somehow physically impossible to fill. They could technically be executed if the price reached them fast enough. The illegality lies entirely in the deceptive intent behind placing them in the first place. The intent was never to trade them. It was always to cancel them after they created a false illusion of market interest to benefit another trade.
It's the intentional deception using the order book itself as the weapon. That's the core of spoofing. So why is this illegal? Did it used to be a gray area?
It was less explicitly defined before, but it was explicitly made illegal as a specific disruptive trading practice under the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010.
Ah, Dodd-Frank. That came after the financial crisis.
Right. Before Dodd-Frank, regulators might have tried to pursue spoofing under more general anti-fraud or anti-manipulation rules, which could be harder to prove. But Dodd-Frank specifically called out and prohibited disruptive trading activities, including spoofing by name in the commodities and futures markets, and similar principles apply in securities markets.
So Dodd-Frank gave regulators a clearer tool.
A much clearer, sharper tool. And the sources note that spoofing can also sometimes be prosecuted under broader statutes like commodities fraud or wire fraud, depending on the specifics of the scheme, as we've seen in some actual enforcement cases.
Technology seems absolutely central to making this kind of thing possible on a meaningful scale, right?
Oh, completely. High-frequency trading, HFT, and sophisticated algorithmic trading systems are really the key enablers of modern spoofing.
How so?
Well, HFT allows traders to place and, crucially, cancel thousands, even millions of orders across multiple markets within fractions of a second, milliseconds, or microseconds.
That speed is hard to comprehend.
It is. And complex algorithms can automate this entire spoofing process. They can be programmed to identify specific market conditions, place multiple layers of those large, non-genuine orders at strategic price levels, constantly monitor the market's reaction, trigger the execution of the smaller, genuine order when the price moves favorably, and then instantly cancel all the fake spoof orders before they get hit.
All faster than a human could possibly react.
Way faster. And the sources actually note an interesting point. The sheer speed and automation enabled by HFT arguably makes markets more susceptible to spoofing attempts.
I see. You'd think faster markets would be more efficient.
In some ways, yes, but it also makes it much harder for other market participants, whether they're human traders or even other algorithms, to distinguish genuine trading intentions from these fleeting fake orders that appear and disappear in the blink of an eye. The noise level increases, making the genuine signals harder to spot.
I also saw the term layering mentioned in the sources. Is that the same thing as spoofing or something different?
Layering is described in the sources as a specific technique that is very often used in conjunction with spoofing, and it's also illegal. They're very closely related, often used together.
Okay, so how does layering work?
Layering typically involves placing a genuine order on one side of the market. Let's say you genuinely want to buy 100 shares at the current price. Then, to help that buy order get filled favorably, you would simultaneously place multiple non-genuine sell orders at different price levels above the market. Maybe sell orders at $50 a 5, $50 a 6, $50 and 7 cents, etc., with the intention of canceling them quickly.
So you're creating fake supply above a market to influence your real buy order below.
Exactly. The idea is that these layers of fake sell orders might pressure the market downward slightly or perhaps trick other traders' algorithms into placing buy orders lower, potentially interacting more readily with your genuine buy order at your desired price. Once your genuine order gets filled, you cancel all those fake sell layers.
So layering is basically a specific way of structuring the fake orders used in a spoofing strategy, using multiple price levels.
That's a good way to think about it. It uses multiple price levels to create that illusion. Both spoofing, the general act of placing orders intended to be canceled, and layering, the specific technique of using multiple price levels, are prohibited disruptive practices.
Okay, that makes sense. Let's talk about the fight against spoofing then, and some of the landmark cases that have shaped this.
Right. As we mentioned, the Dodd-Frank Act in 2010 was really the watershed moment because it made spoofing explicitly illegal in the U.S.
Giving regulators the power they needed.
Yes. And David Meister, who was the director of enforcement at the CFTC around the time Dodd-Frank was being implemented, was actually quoted in one of the sources we read. He emphasized that the new anti-disruptive practices provision in the Act was specifically designed to give them the authority to target and prosecute exactly these kinds of manipulative algorithmic trading schemes, protecting legitimate market participants in the new era of high-speed electronic trading.
And the Michael Cutshia case back in 2013 was the very first time that new Dodd-Frank anti-spoofing provision was actually used in court, right? Making it a real milestone.
It absolutely was the landmark case. It was the first ever enforcement action and the first criminal prosecution brought under the Dodd-Frank anti-spoofing law.
So what did Cutshia do?
Michael Cutshia was a high-frequency trader. He developed and used algorithmic programs specifically designed to place and then rapidly cancel large orders in various futures markets, including commodities and currencies, on exchanges run by the CME Group here in the US and also on European exchanges.
And he made money doing this.
Significant money. Over a period of about 6 weeks in 2011, his spoofing algorithms allegedly generated nearly $1.6 million in illicit profits.
Wow. So he was charged.
He was charged by the DOJ with multiple counts of spoofing and also commodities fraud. He went to trial, was convicted by a jury, and importantly, his conviction was later upheld by the Seventh Circuit Court of Appeals, which really solidified the legal precedent.
Can you describe his specific technique again? The sources seem to detail it.
Yes, the court documents and sources detail it quite well. Kosia's algorithms worked by first placing a relatively small iceberg order. That's an order type where only a small fraction of the total intended volume is visible to the market at any one time. Let's say it was a small order to sell futures contracts, which he did genuinely intend to execute.
Okay, a small real order first.
Right. Then, almost instantaneously after placing that small sell order, the algorithm would flood the opposite side of the market, the buy side, with several very large buy orders placed at successively higher prices away from the market. These were the spoofing orders.
The ones he intended to cancel.
Exactly. These large bids created that false appearance of huge buying demand, suggesting the price was about to surge upwards. This illusion induced other traders or algorithms to react and start buying, which pushed the price up and helped Kosia's original small sell order get filled at a better, higher price than it likely would have otherwise.
And as soon as his sell order was filled,
the algorithm instantly canceled all those large fake buy orders before they could be hit. It was a calculated two-step process. Place real small order, place large fake orders on opposite side to manipulate price towards real order, cancel fake orders once real order fills.
It's a very clever, though clearly illegal, strategy, leveraging how order books work and how algorithms react. You mentioned the Seventh Circuit Court of Appeals was important here. They seem to have been central in defining spoofing legality through a series of cases.
They really have been pivotal. The Seventh Circuit, which covers Chicago, where major futures exchanges are located, has decided a trilogy of key appellate cases that have profoundly shaped how spoofing is prosecuted and understood legally in the U.S. Those are U.S. v. Kosia, the first one we just discussed, U.S. v. Chanu, and U.S. v. Pasilio.
A trilogy. What did these three decisions establish that's been so important for regulators and prosecutors?
Well, together, these three decisions have basically provided a clear legal roadmap for prosecutors bringing criminal spoofing charges. One of the most important recurring themes across all three cases was the court's consistent and firm rejection of a common defense argument.
What was the argument?
The defense often argued that the alleged spoofing orders couldn't be considered fraudulent because they were technically real orders in the sense that they were executable. Meaning, if the market price had reached them and someone had decided to trade against them, the order would have been filled. They weren't imaginary.
They weren't truly fake because they could have traded defense.
Exactly. But the Seventh Circuit just wasn't buying it. They consistently ruled, across all three cases, that the fraud in spoofing lies not in whether the order could theoretically be executed, but in the trader's intent when placing it.
It all comes back to intent.
It all comes back to intent. If the intent was not to actually execute the order, but rather to deceive other market participants and manipulate the price by creating a false market impression, then it constitutes illegal spoofing under the law. The court in Kosia made that crucial distinction between illusory orders, which they agreed the spoofing orders were not, they were real entries on the order book for a time, and creating an illusion of market movement, which they absolutely did.
That's a very important legal distinction. Now, in the Chanu case, didn't the defense try to argue that because their client placed the allegedly spoofing trades manually, not using a super high-speed algorithm like Kosia, that it was fundamentally different? They argued their orders stayed on the book longer and showed more genuine intent.
They did try that argument, yes. They tried to distinguish manual spoofing from algorithmic spoofing, but the Seventh Circuit firmly rejected that argument too. They basically called it the distinction without a difference when it came to proving the necessary deceptive intent. The court reasoned that the manually placed orders in Chanu also could have been executed if the market moved to them, just like Kosia's algorithmically placed orders. The method of placing the order manual versus algo didn't change the fundamental question of whether the trader intended for them to be executed or merely intended to create a false impression and then cancel them. The Pacilio case further reinforced these rulings, cementing the Seventh Circuit's interpretation of spoofing under Dodd-Frank.
So these decisions have really empowered the DOJ and the CFTC in their enforcement efforts against spoofing, regardless of whether it's done by algorithm or by hand.
Significantly empowered them, yes. They clarified the legal standard and shut down some key defense arguments.
Okay, but proving that deceptive intent still sounds like the main challenge for prosecutors. How do courts, based on what the sources say, actually go about proving that a trader truly intended to cancel those orders and wasn't just, reacting to changing market conditions or genuinely changing their mind? The legal analysis source mentioned something like a virtual checklist of factors courts look at.
Yeah, that's a good way to conceptualize it, though it's not like a formal checklist they tick off. The legal analysis we looked at draws out the common types of evidence and patterns that the Seventh Circuit and other courts have found persuasive in inferring that fraudulent intent in spoofing cases.
Okay, what kind of factors are on this virtual checklist?
Well, one big one is the sheer percentage of a trader's large orders that get canceled compared to the percentage that actually get executed. If a trader places, say, thousands of large orders over a period, but cancels 99% of them before they can possibly be filled, while their smaller orders on the other side of the market consistently get filled.
That was pretty suspicious.
It looks very suspicious. It strongly indicates an intent not to trade those large orders. So courts look closely at cancellation rates.
They're looking for patterns in the trading data.
Exactly. Data patterns are huge. Another factor is the relative fill rates between a trader's large orders and their small orders. If the small orders are getting filled at a rate consistent with market conditions, but the large orders almost never ever get filled, it again suggests the large orders weren't genuinely meant to interact with the market liquidity.
What about the technology itself?
The design of the computer program or algorithm used is often critical evidence, as it was in the Cassia case. If the program is explicitly coded or designed to automatically withdraw the large orders before they can reasonably be expected to trade, or if it's designed to place them only in conjunction with an opposite side order, that's pretty direct evidence of the intended strategy.
How long the orders actually stay on the order book matters too, right?
Yes, definitely. Courts often compare how long the challenged large orders remain visible on the order book compared to how long other traders' large orders typically persist in that same market. If a spoofer's large orders consistently appear for only milliseconds, or a tiny fraction of a second before being canceled much, much faster than the average lifetime of a genuine large order, it further supports the inference that the intent was always to cancel, not to trade.
Okay. Any other factors?
Another metric sometimes used is the trader's overall order-to-trade ratio. That's the ratio of the total volume of orders they place compared to the total volume of trades they actually execute. A vastly disproportionate ratio where someone places orders for billions of dollars worth of securities but only actually trades a tiny fraction of that can be highly indicative of placing massive amounts of orders just for show, i.e. spoofing.
And finally, does it matter if the trader knew the rules?
Yes, that can be relevant to proving knowing or willful intent. Evidence that the trader received specific compliance training on anti-spoofing rules or internal emails or communications showing they were aware that placing orders with the intent to cancel was prohibited can be used by prosecutors to demonstrate that the trader knew their actions were wrong and were undertaking them deliberately, not just by mistake.
So while there might not be a single smoking gun quote saying, "I intended to spoof," prosecutors build a compelling case for deceptive intent by combining these behavioral patterns, data analysis, technical evidence about algorithms, and evidence of the trader's knowledge.
Exactly. It's usually a combination of these factors that paints the picture of fraudulent intent for the judge or jury.
Okay. Beyond that major Seventh Circuit trilogy, Cassia, Chinoo, Pacilio, have there been other significant spoofing cases mentioned in the sources? Does enforcement continue?
Yes, enforcement definitely continues. The sources mention a trader named Eric Moncada who faced substantial fines and penalties from the CFTC for alleged spoofing activity in wheat futures markets.
Wheat futures, okay.
And showing this is still very much a current issue, one source noted that just recently, in November 2023, a trader at the investment bank Jefferies was criminally charged by the Department of Justice with securities fraud and wire fraud for alleged spoofing activity in the U.S. Treasury market. So it remains an active area for both regulatory actions and criminal prosecutions.
And wasn't there also a major class action lawsuit related to this back in 2014, something called Providence versus Wall Street?
Yes, that was a significant civil lawsuit. It was a class action brought by the City of Providence, Rhode Island's Public Employee Pension Fund. They sued not just trading firms, but also major stock exchanges themselves.
What do they allege?
The suit alleged broad, systemic, manipulative conduct across the markets, explicitly including spoofing and layering tactics. They claim that certain high-frequency trading firms were routinely placing orders with corresponding cancellations, often strategically timed around the market open or close, specifically designed to distort prices and induce reactions from other market participants, harming investors like the pension fund. While the outcome was complex, the case itself highlighted widespread concerns and allegations about manipulative high-frequency trading practices at the time.
And perhaps the most famous or infamous spoofing case, the one linked to a massive market event, the Vinder Singh Sarao. He's often called the Hounslow day trader and linked to the 2010 flash crash.
Ah, yes, Navinder Sarao. His case is probably the highest profile example, partly because of its alleged connection to the flash crash. Although it's interesting, his charges and eventual conviction actually came quite a while after the event. He was charged by U.S. authorities in 2015, 5 years after the crash itself.
And what was he accused of?
Sarao, who was famously trading from his parents' home in Hounslow, a suburb outside London, was charged by the DOJ and CFTC with multiple counts of wire fraud, commodities fraud, and market manipulation. He was specifically accused of using automated trading programs, algorithms, which he reportedly modified himself from commercially available software to systematically spoof the E-mini S&P 500 futures market, which is one of the most heavily traded futures contracts in the world.
And this was happening right before and during the flash crash on May 6th, 2010.
That was the core allegation, yes. The CFTC, in its reports and complaints, concluded that Sarao's spoofing actions on that day significantly contributed to the order book imbalances that exacerbated the extreme price decline during the flash crash.
How did his spoofing allegedly contribute?
The allegation was that he placed huge numbers of E-mini S&P 500 futures sell orders, cumulatively worth tens or even hundreds of millions of dollars at times, but used his algorithms to constantly modify and cancel them extremely rapidly and repeatedly before they could trade. One source mentioned he modified or canceled these orders something like 19,000 times in just a few hours leading up to the crash.
19,000 times.
Yeah, an incredible number. The theory was that these actions created a powerful, false impression of overwhelming selling pressure in the E-mini S&P 500 futures market, which is a key benchmark. This allegedly contributed to the already fragile market conditions that day, helping to trigger the cascade of selling that led to the dramatic, near-trillion-dollar plunge and rebound in the broader stock market within just a few minutes.
It's just incredible, really, that a single individual operating as a relatively small-time day trader compared to major institutions trading from his parents' house could be credibly linked by regulators to such a significant and disruptive market event.
It truly is. It starkly highlights the interconnectedness and perhaps the fragility of modern high-speed electronic markets. It shows how potentially manipulative practices, even by one participant, can have disproportionately large and destabilizing effects in certain conditions.
It certainly adds weight to comments made at the time, like those from Andrew Haldane, who was then the Bank of England's chief economist. One source mentioned his speech calling the flash crash a near miss for the financial system.
Yes, in a speech titled The Race to Zero.
And questioning how well regulators and even experts truly understood the complex dynamics and hidden risks within these incredibly fast electronic markets. Sarao's case became a symbol of those concerns.
Absolutely.
And there's that interesting, almost ironic layer to his story where Sarao himself reportedly spoke out against other high-frequency traders and practices like, quote, stuffing, flooding the market with excessive orders, while simultaneously being accused of using his own sophisticated algorithmic tactics for manipulation.
Yeah, it definitely adds a layer of irony and complexity. It perhaps suggests that even within the high-speed trading world itself, there wasn't, and maybe still isn't, universal agreement on exactly where the line falls between aggressive but legitimate trading strategies and outright manipulative practices. His case remains a really potent reminder of the potential impact of disruptive trading and the ongoing debate around HFT.
Okay, wow. So we've covered the definitions, the rules, how they work, the technology involved, and the major enforcement cases for both front-running and spoofing. It's abundantly clear that regulators view these as serious threats to market integrity. So the big question is, how are regulators and the firms themselves actually fighting back? what detection and prevention measures are in place to stop this stuff?
Right. This is obviously a critical area because, as the sources consistently reiterate, successfully combating these forms of manipulation is absolutely essential if we want to maintain investor confidence and the overall health, fairness, and efficiency of our financial markets.
And presumably the consequences for getting caught are designed to be a strong deterrent.
Very much so. The sanctions described in the sources are quite severe and multifaceted. We're talking substantial financial penalties, often running into the millions or even tens or hundreds of millions of dollars in large institutional cases like HSBCs.
Money penalties are just the start.
Often, yes. There's typically disgorgement of any illegal profits made from the activity. You don't get to keep the spoils. Regulatory bodies like FINRA, the SEC, or CFTC can suspend or permanently revoke trading licenses for individuals and firms. Individuals involved can be banned, sometimes for life, from working in the financial industry entirely.
And criminal charges are possible too.
Absolutely. In the most egregious cases, especially where there's clear evidence of intentional fraud and significant market harm or large illicit profits, like in the Cossier or Sorrell cases, criminal charges leading to potential prison sentences are definitely on the table. The severity of the sanctions usually depends on factors like the scale and duration of the manipulation, the amount of profit gained or loss avoided, and the strength of the evidence proving intent.
Okay, so the stick is pretty big. What about prevention? What are financial firms themselves doing on the front lines to prevent and detect this kind of activity within their own operations?
Compliance is just a massive, massive effort and expense in the modern financial world, and detecting manipulative trading patterns like front-running and spoofing is a huge focus of that effort. The sources highlight advanced trade surveillance systems as really crucial tools.
Using technology to fight technology.
Pretty much. Firms are deploying increasingly sophisticated surveillance technology, often powered now by artificial intelligence, AI, and machine learning. These systems are designed to sift through the absolutely vast amounts of trading data generated every single second across multiple markets.
What are they looking for?
They're programmed to look for suspicious patterns, anomalies in order placement, high rates of order modification or cancellation relative to executions, unusual timing of trades relative to known client orders or news events, patterns indicative of layering or spoofing or trading ahead of client orders. They flag potential issues for human compliance officers to investigate further.
It sounds like a monumental data analysis challenge.
It really is. That's why they need real-time or near real-time monitoring of order flows and execution patterns across all their trading activities. But it's not just technology. Firms also rely heavily on strict internal controls and clear segregation of duties.
Like those information barriers, the Chinese walls you mentioned earlier.
Exactly. Enforcing effective information barriers between departments that handle sensitive, non-public information, like investment banking, research, or large client orders desks, and departments that execute trades, like proprietary trading or market making, is fundamental to preventing front-running based on internal information leakage.
Monitoring employees' personal trading accounts must be essential too, right? To catch individuals trying to front-run using their own accounts.
So absolutely. Firms typically have very rigorous policies, pre-clearance requirements, and ongoing monitoring systems for employee personal trading accounts to ensure they aren't misusing firm or client information for personal gain. Using precise, synchronized timestamping and maintaining detailed records of the sequence of all orders and trades is also standard critical practice. This creates an auditable trail that allows compliance teams or regulators later on to reconstruct trading activity precisely and analyze it comprehensively, looking at the exact timing of orders, price movements, and the sequence of trades relative to when internal information was known or when client orders were received.
So lots of monitoring and controls. What about training and reporting mechanisms?
Yes, those are key too. Regular internal audits and external compliance reviews are standard practice to check if the controls are working. Importantly, firms provide mandatory employee training on ethical conduct and trading practices, and this training specifically covers prohibited activities like front-running and spoofing in detail. They need to make sure everyone, from traders to analysts to operations staff, understands the rules and the severe consequences of violating them.
And encouraging people to speak up if they see something wrong.
Crucial. Many firms have internal reporting mechanisms like confidential hotlines and robust whistleblower policies designed to encourage employees to flag any suspicious activity they observe internally, hopefully before it becomes a major problem or attracts regulatory attention.
Now, you mentioned AI being used for detection, which sounds positive, but the sources also noted that AI is kind of a double-edged sword. in this ongoing fight against manipulation. How so?
Yeah, it truly is part of this constant technological arms race between the manipulators and the enforcers. On the positive side, AI and machine learning are becoming incredibly powerful tools for surveillance teams. They can analyze patterns across massive, complex data sets in traditional markets far more effectively and quickly than older rule-based systems or human analysts alone, helping to detect subtle or novel manipulative patterns.
Okay, that's the good side. What's the bad side?
The bad side is that the same sophisticated AI technology is also being deployed by those who want to manipulate the markets. The sources specifically noted examples of highly effective, automated front-running bots being developed using AI, particularly in less mature or perhaps less regulated market spaces, like certain areas of cryptocurrency trading.
How do these AI front-running bots work?
They can be programmed to constantly scan public transaction logs, like the blockchain mempool in crypto, or exchange order books, use AI to identify indicators of potential large incoming trades before they are fully processed or confirmed, and then automatically execute their own trades faster than any human possibly could, exploiting the tiny temporary price inefficiencies or movements caused by that pending large transaction.
So the same powerful technology used to catch manipulators can also be used by manipulators to become even more efficient and harder to detect, operating at incredible automated speed.
Exactly. It means that regulators and compliance teams have to constantly evolve their own detection methods, often using AI themselves, just to try and keep pace with the increasing sophistication of the manipulative algorithms being developed. It's a continuous cat-and-mouse game.
Which really brings us back to the absolutely crucial role of human beings specifically, whistleblowers. The sources really seem to highlight them as invaluable in this fight.
They are absolutely critical. You can't overstate their importance, especially in uncovering practices that might be deliberately designed to evade automated surveillance systems or those that happen in less transparent environments like over-the-counter OTC markets, such as swaps trading, where much of the activity isn't publicly visible on an exchange order book. Whistleblowers provide that irreplaceable human insight.
And the Dodd-Frank Act, the same act that explicitly outlawed spoofing, also significantly boosted whistleblower programs, right?
It did, yes. It established or significantly enhanced whistleblower reward and protection programs at both the SEC and the CFTC.
Let's focus on the CFTC whistleblower program, as spoofing was a key focus there. How does it work?
Okay. The CFTC has a robust whistleblower program specifically designed to incentivize individuals who possess original, non-public information about violations of the Commodity Exchange Act to come forward and report it. This explicitly includes reporting things like commodities fraud, market manipulation tactics like spoofing, and violations related to swaps trading.
What's the actual incentive for someone to take the risk and come forward?
It's potentially a very significant financial incentive. If the information voluntarily provided by the whistleblower leads to a successful CFTC enforcement action where the agency collects monetary sanctions totaling $1 million or more.
Okay, $1 million threshold.
Right. If that threshold is met, the whistleblower is mandatorily eligible for an award. The award amount is set by the commission, but must fall within the range of 10% to 30% of the total amount collected in sanctions.
10 to 30% of potentially millions, that's a serious reward for providing crucial information that leads to enforcement. How does someone actually go about reporting, according to the sources?
The formal process described is to submit a specific form called a Form TCR, which stands for Tip, Complaint, or Referral directly to the CFTC's dedicated whistleblower office.
Can they do it online? Anonymously?
Yes. The sources say this form can be submitted electronically through the CFTC's website or alternatively via fax or mail. And importantly, whistleblowers can choose to submit their information anonymously. However, if they wish to remain anonymous throughout the process and still be eligible for an award, they generally must be represented by legal counsel.
Who is actually eligible to be a whistleblower under this program? Can anyone report?
Pretty much any individual can be a whistleblower. The sources note this explicitly includes people like corporate officers or insiders within a firm, traders, either current or former, other market observers who notice suspicious activity, investors who believe they've been harmed by fraud or manipulation or other victims. The key is that it has to be an individual. A company or another business entity itself cannot receive a whistleblower award. It's designed for people. And critically, the program also provides vital protections for whistleblowers. Dodd-Frank includes strong anti-retaliation provisions. Employers are strictly prohibited from firing, demoting, harassing, or otherwise retaliating against employees because they provided information to the CFTC under the whistleblower program.
That protection is essential. Otherwise, people would be too afraid to come forward.
Absolutely crucial. Whistleblowers also have the right to appeal award determinations made by the Commission to a federal court if they believe the decision regarding their award eligibility or amount was incorrect.
And is the program actually working? Are people using it? The sources mentioned an increase in tips.
Yes, the data suggests it's gaining significant traction. The CFTC's whistleblower office has reported a dramatic increase in the number of tips received in recent years, including, as one source noted, a 126% increase in submissions in the fiscal year 2020 alone. That's a huge jump.
And they're paying out awards.
They are. The program has reportedly issued awards totaling over $120 million since its inception, tied to enforcement actions that resulted in much larger sanctions being collected. This demonstrates its effectiveness in incentivizing people with valuable information to come forward and helping the agency bring significant enforcement cases. And the sources also note that the SEC's whistleblower program, which covers securities fraud and manipulation, is structured almost identically and has also been highly successful, paying out even larger aggregate awards.
So it seems clear that whistleblowers really are a vital line of defense, complementing all the technological surveillance, especially in those harder to monitor, more opaque corners of the financial world.
Absolutely. They provide that crucial human intelligence, the insights into intent and context that automated systems might miss, particularly for complex schemes or activities happening off exchange or behind closed doors. They are indispensable.
Well, this has certainly been a very deep dive into some of the more hidden but absolutely critical aspects of maintaining market integrity. We've really unpacked front-running.
Yeah, that illegal head start based on knowing about upcoming market activity before others do.
Right. Based on that non-public knowledge, often related to large client orders or maybe upcoming research recommendations.
Yeah.
And then we examined spoofing.
Which is totally different, creating those false market signals, using orders you place but fully intend to cancel, relying heavily on speed and algorithms to manipulate the price.
We've seen why both of these tactics are unequivocally illegal, actively prohibited by major regulators like FINRA, the SEC, and the CFTC through specific rules like FINRA 5270 and landmark legislation like the Dodd-Frank Act.
And we looked at some really significant real-world cases, HSBC, Citadel Securities, Michael Kossia, Navinder Sarao, that illustrate how these tactics are identified, prosecuted, and the very serious consequences involved for both firms and individuals.
And we've discussed how firms and regulators are fighting back. They're using sophisticated surveillance technology, increasingly AI-driven.
Alongside rigorous compliance programs, mandatory training, strict internal controls like information barriers.
But we've also acknowledged that ongoing challenge posed by the fact that sophisticated technology, like AI, is also being used by the manipulators themselves in this constant arms race.
And crucially, we highlighted the absolutely invaluable role of whistleblowers and the dedicated programs born from Dodd-Frank that incentivize and protect them, helping to bring these hidden, often complex, manipulative practices into the light and ultimately reinforcing market integrity for everyone.
It's clearly a dynamic, constantly evolving landscape, this battle against market manipulation, which I suppose leaves us with this final thought for you, our listener, to ponder.
Yeah.
As trading technology becomes even more advanced, faster, more complex, and as algorithms driven by AI continue to dominate more and more market activity, how will the very nature of these manipulative tactics change? What new forms might emerge that we haven't even thought of yet?
And how will regulators and enforcement agencies need to adapt their own strategies, their own tools, perhaps even their own use of AI, to keep pace and ensure that markets remain fair and trustworthy for everyone participating?
It's a fascinating and, frankly, vital question for the future of finance. Hopefully this deep dive has equipped you to better understand the unseen forces sometimes at play in the markets and to appreciate the constant vigilance required from all sides to maintain trust in our financial system.
Indeed. Staying informed, understanding these mechanisms, is really the first essential step in staying vigilant.